Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about LX Technology Group Limited annual report. LX Technology Group Limited offers a range of business solutions that cater to the needs of various customers. The company provides device lifecycle management solutions primarily in China and Hong Kong. Its services can be broadly categorized into two segments: device recycling business and device subscription services. The device recycling business involves the sale of refurbished, decommissioned IT devices to resellers through a proprietary quotation platform. This service helps reduce electronic waste and provides cost-effective options for customers looking to purchase pre-owned IT equipment. In addition, LX Technology Group Limited offers device and IT technical subscription services to small and medium-sized enterprises, SMEs. These services provide ongoing support and maintenance for IT devices, ensuring that they remain operational and up-to-date with the latest technology. By providing these solutions, LX Technology Group Limited helps its customers manage their IT assets more efficiently and effectively. LX Technology Group Limited maintains a market capitalization of $5 billion, broadly in line with the industry peer group. LX Technology Group Limited trades at a higher price-to-earnings ratio of 306 times and a higher price-to-book ratio of 5.52 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 58% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through a thorough analysis of the company's financial performance. On the positive side, several factors have contributed to revenue growth. Firstly, an increase in gross profit across all business segments has been a significant driver of revenue growth. Additionally, the optimization of device mix for device recycling and strategic pricing for the sale of devices have also led to increased revenues. Furthermore, the rise in demand for device subscription services and strategic pricing of certain popular models of devices have further boosted revenue growth. The company's improved operational efficiency has also played a crucial role in driving revenue upwards. In terms of specific numbers, the device recycling business saw a 16.3% growth in mobile devices and a 7.3% growth in IT technical subscription services. On the other hand, several factors have contributed to revenue decline. The instability of gross margin for device recycling business has been a major concern, as well as uncertainties brought by usage and demand of DLM solutions and targeted markets in China. Pricing sensitivity to economic downturns of target customers has also led to decreased revenues. Furthermore, a decrease in revenue from contracts with multiple performance obligations and other income has contributed to the decline. Overall, it is clear that revenue growth and decline are driven by a range of factors, including gross profit margins, device mix optimization, pricing strategies, demand for subscription services, and operational efficiency. By understanding these drivers, companies can make informed decisions to mitigate risks and capitalize on opportunities for growth. The company's net income and profit margins underwent significant changes between the specified periods. Initially, the company turned a net loss into a net profit in 2025, indicating a substantial improvement in its financial performance. The net income increased by 26.3%, rising from RM 100 and 96.4 million to RM 100 and 48.1 million. However, this upward trend was short-lived, as the net income decreased by 12.45% in the subsequent year. Despite this decline, the company's profit margins continued to improve across its major business segments. The gross profit margin increased from 8.3% to 10.4%, while the device recycling business saw a notable improvement, with its gross profit margin rising from 0.5% to 1.9%. These improvements were attributed to enhanced operational efficiency and revenue quality enhancement. The increase in profit margins was also driven by the growth of the company's major business segments, including device recycling, subscription services, and IT technical subscriptions. Overall, while the net income experienced a decline, the company's profit margins continued to rise, indicating a more stable financial foundation for future growth. The company's financial performance indicates a positive trend in its operating cash flow. The data from various pages of the report confirms this assertion. On page 41, it is stated that the net cash generated from operating activities for 2025 was RMB 449,722, which is significantly higher than the previous year's RMB 51,421. Furthermore, on page 42, it is explicitly mentioned that the operating cash flow is positive for 2025. This reinforces the notion that the company is generating sufficient cash from its core operations to meet its financial obligations. Additionally, on page 76, the net cash from operating activities for 2024 was RMB 1,234,000, which is a notable increase from the previous year's RMB 1,045,000. Lastly, on page 81, it is reported that the operating cash flow for 2025 was RMB 156,134. This figure, although lower than some of the other years mentioned, still indicates a positive operating cash flow. Overall, these data points collectively suggest that the company is generating sufficient cash from its core operations to meet its financial obligations and invest in growth initiatives. The company's debt level and interest expenses have undergone significant changes. Initially, the debt level appeared to increase by RMB 70,119 on page 40. However, a closer examination reveals that borrowings actually decreased from RMB 12,437 to RMB 26,381 on page 80. This discrepancy suggests that the company's debt level is more complex than initially thought. Upon further review, it becomes clear that lease liabilities and financial liabilities at amortized cost have increased, contributing to a total increase in borrowings of 8.6% on page 79. This nuance highlights the importance of considering multiple sources when evaluating the company's debt level. In terms of interest expenses, there is a general trend of increase. On page 60, interest expenses on borrowings rose by 3.4%, from RMB 46,608 to RMB 48,063. Similarly, on page 80, interest expenses, finance costs, increased from RMB 47,562 to RMB 49,026. However, there is a notable exception on page 40, where interest expenses decreased by RMB 1,464. Overall, while the company's debt level and interest expenses have undergone changes, it appears that interest expenses have generally increased, with some discrepancies in the information provided. The company's performance across various segments and regions has been mixed in the recent period. On a positive note, device subscription services and IT technical subscription services have seen significant growth in gross profit, with increases of RMB 14.8 million and RMB 11.2 million respectively. In terms of regional performance, Shenzhen has emerged as a standout, with revenue increasing by 82.5%. Shanghai also reported a notable increase of 6.6%, while the PRC saw a modest growth of 13.1%. However, some segments have struggled to keep pace. The device recycling business has been particularly affected, with revenue declining by -30.3% due to decreases in both non-mobile and mobile devices. Additionally, the computility-related business segment's performance is unclear due to lack of data. Wuhan reported a decline of 1.8%, while Hong Kong saw a significant drop of -94.6%. These regions will need to be closely monitored for improvement in future periods. Management is optimistic about the company's future prospects, citing opportunities for business development and growth. To achieve this, they aim to maintain a balanced workforce with an ultimate goal of achieving gender parity. The company's success will depend on various factors, including market penetration, digitalization, and environmental sustainability awareness. Effective communication and transparency are crucial in building confidence among shareholders and investors. Management believes that integrating social values into the business is key to continued growth and has outlined a strategy to recognize employee contributions and reward them with a personal stake in the company. This approach will not only retain employees, but also incentivize them to contribute to the company's long-term success. The company's financial history reveals a commitment to rewarding its shareholders through dividend payments. According to the information provided on page 83, the answer is clear. The company has indeed paid dividends. This indicates that the company values its shareholders and seeks to return value to them in the form of cash distributions. Concerns about inventory buildup and supply chain disruption are evident in the recent data. Inventory levels have seen a significant increase of 18.6% from RM102.8 million to RM121.9 million, indicating potential stockpiling issues. This is further supported by the fact that merchandise goods increased by RMB 19,147, 18.7%, over the same period. However, this buildup may be indicative of a more complex issue: supply chain disruption. Trade payables have risen by 15.9% from RM107.4 million to RM124.5 million, suggesting that suppliers are being paid later than expected. Furthermore, advances to suppliers decreased by RMB 20,052, 49.5%, and past due balances increased significantly, indicating potential payment delays or defaults. These signs of strain in the supply chain may be contributing to the inventory buildup, as companies struggle to manage their stock levels amidst disruptions. That concludes the financial summary for LX Technology Group Limited. Feel free to comment below, and I will be happy to answer them when possible.